Well, you got to be flipping my flapjacks. Today's the rare buy one, get two free. In this one, 3 videos for me to react to. First one up here. Dividend stocks may see reversal since they're as cheap as they were in the 1990s. I want to hear what this woman has to say, kind of share my perspectives and opinions on stocks and dividend stocks in that one. Then we're going to go ahead and react to this video, buy stocks with strong balance sheets and competitive moats. I want to hear what her examples are of companies that she feels have very strong balance sheets and competitive moats, and I'll kind of share some of my opinions on some of those companies as well in this one. And the last video I want to react to is Mike Bailey believes the Magnificent Seven are down but not out. Magnificent Seven is what they call them now. Google McDougal, you have Amazings on, you have Nvidia, you have obviously Apple, you have Meta, Microsoft, and good old Tesla. Massa. Wow. Oh my gosh, look at the move for Tesla. That one's obviously been hit the most significantly. But also do remember, Tesla is by far and away more negatively affected by interest rates than these other guys are, right? With how high interest rates have gone recently, I mean, it hits everybody and it hits the economy more and more as time ticks on. But automakers, it hits them the most. I mean, that's where people pull back the most, obviously, because just interest rates. If you're talking about, you used to be able to get an auto loan at 2.5%, and now you're paying 7, 8, 9%. Even if you have good credit, that's a night and day difference, okay? Appreciate y'all joining me as always. Thanks so much for being here. New all-time high subscribers in the history of the channel. We broke through our one-day moving average, and I appreciate y'all being here, guys. Alrighty, let's get into this.
Why would I want to be in a dividend stock when I can be in a money market fund or a lot of the fixed income
Good point.
assets right now that are paying much higher yields? We've got some competition.
I totally hear what you're saying, and I think most people are running through that calculus as they think about where to put their money right now. But the thing is that dividend stocks grow their dividends, where treasuries, you get one coupon, you have the coupon for the duration of the bond, and that's it. So if you think about what a bond that's yielding 4% can give you over a 5-year period, if you can find a dividend stock that's paying 3% and is growing their dividend at 10%, you're going to end up ahead over a 5-year period of time. Now, if you add inflation into the mix, you're actually going to be better off because many of these companies have pricing power, and they're going to be able to price their products, their profits are going to go up in line with what inflation is. And so you become ahead of the game where you won't in a fixed income security.
Thank you. Oh my gosh. Okay. That's one of the things that doesn't get, and what, if you look at the stocks I'm really buying this year specifically, you're going to find I'm putting more money than ever this year into value stocks and dividend stocks. Why? It's where I see the real opportunities. Growth stocks have gone on a tremendous run, obviously, this year. Growth stocks were the ones to buy last year. Everybody sold every great growth stock off 50, 60, 70, 80%. And there was your platter, your all-you-can-eat buffet of growth stocks out there. The Metas, Nvidias, Teslas, all these companies, AMD, name every one, okay? Shopify, Netflix, they're all right there. That was last year. This year, it's values and divs. And like we stated at the beginning, right? Sarah, I believe Eisen is her name, right? She's talking about the same point everybody makes. Well, why would I put money in a dividend stock when I can get 4+% from a savings account, a CD account? Why would I put money in a dividend stock when I can buy a 6-month treasury and get 5-something%, right? And that's a good argument. But to push back against that is dividend stocks don't usually trade this cheap, right? So right now you're getting great pricing on dividend stocks. And 2, if you own great dividend companies, what do great dividend companies do? They raise their dividends each and every year over years and years and years. So you might be buying a dividend stock today, and let's say that stock's paying a 4.5% yield. Okay, so you're buying this dividend stock, it's a 4.5% yield. And you're saying, well, why the hell am I taking the risk in this dividend stock versus just buying a treasury or put my money in a savings account? I get 4.5%, a CD account through SoFi or Ally or one of those guys, right? It's a fair point, but you got to understand, you buy that treasury, you're stuck at that number, right? Great dividend stock, on the shares you bought, that yield is going to end up likely going to 5%, 5.5%, 6%, 7%, 8%. All of a sudden, 10 years go by, and now the shares you bought, the yield you're getting on your shares are also 9%, 11%, right? That's the fun of dividend investing. Warren Buffett has, very famous, he's got shares of Coca-Cola that he was buying back in the 80s, right? That he gets paid more in dividends in a year than he paid for the entire stock. So he's basically getting over a 100% dividend yield on some of his Coca-Cola shares today. Over a 100% dividend yield versus what he paid for the shares. Like, this is like mind-blowing, right? There's definitely some stocks I hold in my dividend account that the yields they pay me today are much larger than what I used to. Tapestry, when I used to own Tapestry, there was a big dividend yield even back then. But based upon the price I was buying, based upon, the kind of dividend yields they had raised, I think I was getting like an 8 or 9% dividend yield or something insane. So that's the fun with dividend investing. Not enough people talk about that.
Total sense, but it's not the way the market is looking at it right now. So do you need to see a reversal in rates for dividend stocks to work?
That's an interesting question. And I don't really know if that's the case or not. They are so cheap right now that maybe you just have a reversal based on the fact that they are as cheap as they've been since the tech boom of the 1990s. And when we did that, we were 3 standard deviations cheap relative to that period. We're 3 standard deviations cheap now. And they went on to have a great decade. They were the outperformers for the next 10 years. And that could happen again in our mind.
On what metrics are they cheap? How do you do that analysis? And I also wonder what sectors tend to surface as being more.
Yeah, I don't know if a lot of that's the right way of looking at it, to be quite frank, right? Or dividend stocks going to outperform or underperform these growth stocks. I don't look at it that way. I mean, the main way I think about dividend stocks, right, is one, usually these companies should be the type of companies that I can hold for 5-10 years. And, if I wasn't allowed to sell the stock, like, I would just be happy holding that stock, okay? That's the first thing. You're paying for, which is not the same that can be said for growth stocks. Growth stocks, these companies move around a lot. 1 minute they could be growing super fast and have command a huge valuation. The next minute it's totally different. PayPal's a great example, right? And I love buying PayPal stock right now. But damn, PayPal was a $300 stock. It's $58 today, okay? And that's in a matter of 2 years. It went from $300 to $58. When you got great dividend companies, they can certainly make moves down, but usually they're not going to go from 300 to 58 unless it's a really poor quality dividend company. Those sorts of moves don't usually happen, right? So I look at it from kind of that perspective, and then once again, it's about just that generating that cash flow. That, because there's going to be certain time periods in the market when the indexes aren't going up. The indexes can stagnate for 5-10 years. I don't think a lot of people understand that because we went through such a boom time, obviously bottoming out the market from 09 all the way through 2021. We went through such an insane boom in the S&P 500. Not a lot of people even conceive of the possibility where the S&P 500 is flat from 2021 through 2030. Not a lot of people can even go there mentally. It's a possibility. You have a big, huge recession that was to send the market down. Then you have to recover back up from there, right? Stanley Druckenmiller, right? Very famous, super successful investor, said he expects his decade to be the decade you're not going to get gains in the indexes, right? These are possibilities. It's not for sure, but it's a possibility, right? So imagine you're in this sort of scenario where it's hard to get share price appreciation. Let's just say that's the situation, right? Damn, those dividends are looking great. Because if you're being able to own dividend stocks that are throwing you off that cash flow every 3 months, and you own a bunch of them, right? Cash flow, cash flow, cash flow. You're able to continue to buy these other great stocks that maybe are trading at big discounts, yet their stock prices aren't moving, while maybe their business fundamentals are getting better and better, but their stock prices aren't moving. And you're able to just allocate more shares and more shares and more shares as your dividend stocks are throwing you off all this cash flow. That's a beautiful thing, right? It's like I look at a company like PayPal, right? I love buying PayPal stock right now. Say PayPal, this is probably not going to happen, but let's say it did happen. Let's say PayPal stock doesn't move for the next 2 years. 2 years. I don't think that's very realistic, but let's say it happens. And let's say the business fundamentals just keep getting better and better and better, just as they have for the last 10 years for PayPal, right? 20 years. Damn. I could use all that dividend money that I'm getting thrown off constantly, which is thousands of dollars pretty much every quarter, right? And go ahead and funnel that into PayPal stock or other stocks I love. That's the beauty, okay? So that's, in my opinion, the way to kind of mentally look at dividend stocks in general.
Back to one more space.
What sectors within the income-paying stocks? So the ones that we like are ones that not only have a valuation component, cheap, but also have growth potential. And in our mind, the biggest opportunity here is in industrials. And that's where we have our largest overweight, relative to the market. They have an opportunity to grow, mostly based on the fact that we have an infrastructure boom going on. We have investment taking place because of the IRA. And we also have just really rickety infrastructure all over this country that needs to be rebuilt. And so we think many of these companies like CAT, like Deere, like Eaton are going to be beneficiaries of that. And those are where we have most of our, from a sector bet perspective.
So CAT and those companies, okay, they have something going really good and something that could be potentially going really bad. And so don't get too excited about those stocks, okay? So CAT, obviously, as you just mentioned, the government spending is massive over this next several years in terms of infrastructure, right? It's great for a company like CAT. On the flip side, if you're going to talk, we've been in a building boom for 10 years plus now, okay? Building boom. Homes, apartments, warehouses, look at the data. It's been crazy for years now at this point in time. Look at the amount of warehouse space opened in the past 10 years. It's insane, okay? So we had this obviously massive boom as the economy just got better and better. Unemployment just kept dropping and dropping over the years. That's phenomenal, right? But there's a significant risk. We see a significant, not small, significant slowdown in all that stuff over this next 12 to 24 months, where home building dries up massively, warehouse building dries up massively, retail dries up massively, all this stuff. So from that standpoint, that's a very bad thing. So those players have some sort of protection because of government spending, but they don't have as much as you might think. If you're going to talk about a major recession comes in the economy, and with interest rates going to where they've gone and potentially higher, that's not going to be good for companies like CAT. Believe me on that, in construction, and eventually the economy will get hit, and it will get hit significantly.
You think about how old an investor needs to be to really emphasize this in their portfolio. And how young could you be and still pay serious attention to dividend growing stocks?
Yeah, I think
and that's the other problem with these sorts of stocks, right? We just talked about the component of, if the economy gets hit bad, these companies will get hit, their numbers will get hit. But also, especially somebody like a Deere, it's a 1.25% dividend yield. Give me at least 3%. Give me at least 3% yield to get me interested, right? If Deere's at a 3% yield today, let's say that stock's cut 60%, 65% from here, and it's, roughly a 3% yield, okay, I can consider Deere at that point in time, right? But at a 1.25%, I'm okay. Thanks so. Appreciate it.
An asset allocation, and I understand the logic on why a young person would want to be in something that's got a little bit more growth potential and whatnot. But the valuation of growth stocks is so high relative to the valuation of dividend stocks that I think there's an opportunity for all ages. And when you think about an overall asset allocation, having a little bit of defensiveness in the portfolio makes a lot of sense. And we think of this strategy as being more defensive than the overall market. So if you look at last year, for example, the market was down, call it 18, 20%. We were down 4%. So, in a market that goes down a lot, this offers some protection. And we participate in the upside. We just don't have the juice that being in the, really high flyers provides.
Yeah, I love what she said there. I could apply that in a backwards way as well, because a lot of people wonder, well, if I'm 25, how should I invest versus if I'm 55 years old, right? Obviously, going to change a few things here and there. But at the end of the day, people that are 55 think, I can never own growth stocks. It's too risky. And people that are 25 say, dividend stocks, so sleepy, so boring. I want to own only growth stocks. It's both flawed logic. If you are well diversified properly, you can own growth stocks as an older individual. If you are well diversified as a younger individual, you can own dividend stocks as well. Remember what I gave you the example of Warren Buffett, Coca-Cola back in the 80s, right? And then he's getting 100% plus dividend yield on the shares he bought. Well, if you're younger and you own some great dividend stocks that are compounders and going to raise their dividends each and every year for the next 10, 20, 30 years, do you know the sorts of dividend yields you'll be collecting, the sort of cash flow you'll be collecting in your 40s and your 50s? From some of those great dividend stocks that you're buying today in your 20s? And on the flip side, growth stocks can go on some tremendous runs. So you might think you're 55, I don't have 20 years to wait. If you buy growth stocks at the right timing, you don't have to wait 20 years. You can get some unbelievable gains in a matter of 2 years, 4 years, 6 years, 8 years. And as long as you're not risking the farm on that growth stock, you're just fine. So both are flawed logic. Young people that think I can't own dividend stocks, it's flawed logic. And older folks that think I can never own a growth stock, flawed logic, both of them. It's math, man. It's math. Maybe we need to like get our math in a better place. Is it math or is it psychology? Because I sometimes wonder that. I think it's a combo of both. I think people don't understand math. And I think also people don't understand psychology. And that's why they have these sorts of like flawed logics of like, I can't do this and do that. If you're well diversified, you can do both. Okay. All right. Next video up here. Buy stocks with strong balance sheets, competitive moats. I want to hear what she has to say and if she has some good examples to give us. And then we'll get into what's going on with these magnificent seven.
Red futures in the red over in Europe as well. Some of that pressure from some of the issues in the Chinese property sector. Do you expect that to continue to spill over into the U.S. and concern investors here?
Yeah, listen, we're in the home stretch of August, and, you open the show with all of these, potential items that will affect the market, and we're really anticipating more volatility today. And so I do expect that to continue with the ultimate, impact, the ultimate thing impacting the markets being the Fed, right? But, I think it's really important to note that September is traditionally the worst performing month of the year for the past 22 years. It's been that way. 12 of those months, September's been negative. So now is a good time as we kind of head into thinking about next week to look at your portfolio, see where you need to rebalance and kind of prepare yourself for potential opportunities in September.
All right, so you're saying potential opportunities coming up in just a few weeks, but what about right now? I mean, we're seeing some big mega cap stocks taking quite a dip over the last week or so. Would you buy the dip on these companies right now, or do you think there's more downside pain?
It really depends on the company, So again, when the market's down, it's usually a good time to buy your high conviction names. So it really depends on the company. We don't want to kind of paint our buy strategy with one broad brush. I always, when I'm on the show, kind of talk about our formula at Pivotal. And
so something very important I think everybody should be doing when you're buying stocks right now, okay, is very important. This is different than maybe past years. And I think the reason being is such a significant risk to the economy because of obviously the Fed raising rates and the Fed lags catching up obviously in 2024, 2025. You need to look at this market differently. Here's how I'm looking at a stock before I buy the stock. I'm not thinking about just a situation where their revenues go up to what they've historically been. So let's say a company over the past 7 years has been growing 10% a year. That's not how I'm thinking about it. I'm also considering a more recessionary scenario that let's say that company barely grows. Let's say they're growing 1%, 2%, 3%. Am I still comfortable buying the stock at a 3% growth rate as I would be if they were growing 10%? If I am, then I'm really getting a good deal. That's where I look at something like a PayPal, obviously, and I'm thinking, okay, I think the company's probably going to grow 10-ish type percent of revenue per year for the next several years. But what if they grow 3%? Am I still comfortable owning that stock, right? 4% in a much, much slower economic environment, or dare I say recessionary. So that's how I think you should be thinking about investments right now, which is very different than we've really had to think for the past 10 plus years, to be quite frank.
Like how we buy stocks, it's really about quality, it's about strong balance sheets, and it really is about competitive moat. So, I think investors should really think about what their buy strategy is and kind of identify individual high conviction names.
All right, so with that all in mind, Tiffany, what's your WEX word of the day?
Cautiously optimistic. That's 2 words, I know. But again, we're experiencing some volatility right now. I expect that to continue, and including, potentially into September. But the good news is, for the rest of the year, the fourth quarter is traditionally the highest performing quarter. But again, really pay attention to those names that you have a lot of confidence in and buy those on the dip.
All right, so cautiously, number one, you're sneaking in a phrase. A lot of people have been sneaking in phrases lately.
I am.
With that in mind, you're cautiously optimistic, but give us a sense of some of the plays that you would actually make today, even with that optimism and that caution in mind. You gave us a list of some of them. I want to start with one of them, an AI play, HubSpot. Why are you so bullish on this name? It seems like one of the names that might be deeply impacted by these rising rates. It's also had a huge run up here to date.
Yeah, I mean, it's up over 75% year to date. And again, just a bit of a reminder, at our firm, our clients are institutions. So we are managing money for foundations and endowments, and it's actually over multiple lifetimes, right? So in perpetuity. So we're less of traders and more of long-term investors. And so we look at a company like HubSpot. Yes, definitely it's done extremely well this year, but when we think about their kind of competitive moat and their business model, there's this growing need for CRM systems, right, at a reasonable price, contrasted to like a Salesforce, which is a bit more expensive. HubSpot offers a little bit more and really kind of caters to like that smaller market. And that's really where things are going right now. It's definitely more user-friendly. They actually have really low market share, which we believe kind of sets them up for significant potential for run rate growth.
You're also hitting one of our themes, retail. So you have a pick in the retail space. Lululemon, why would you buy this stock today? It's also had a pretty strong run-up year to date. And in general, kind of considered a more higher-end luxury brand when it comes to sports apparel, when we're seeing that the consumer is a bit stretched.
Yeah, and so you actually bring up a good point. The consumer is a bit stretched. And remember, this year that excess COVID savings is going to run out, and also student loan repayment is going to come back. But
A bit stretched, like some leggings that are just too small.
Lulu has really carved themselves a really nice spot in the market. They have this cult following, right? So for consumers of Lulu is no longer a nice to have, it's a must to have, right? Those Align pants that they have that I have on actually right now are amazing. And they really kind of like they are excellent at listening to their customers and meeting their customers' needs. So not Lulu necessarily just today, but in perpetuity, right? So this is a company that we really like long term. And if it does take a dip today or even Monday, kind of going into next week, I think it's a good opportunity to buy.
Yeah, I do not. I mean, so first off, Lulu's done a phenomenal job running their business. I do not like the valuation on Lulu. That's my main concern. I'd feel much more comfortable in something like a Nike. Nike's been tested through all sorts. No one ever heard of Lululemon prior to like the last 5-10 years. Okay, no one ever heard of Lululemon. So Lululemon hasn't even gone through recessionary environments or anything like that. A name like Nike on the flip side, they've gone through it all. Companies well established. They've gone through ups and downs with their brand, stronger at certain times, weaker at other times. They've gone through all this. Lulu hasn't gone through that stuff yet. So I think Lulu's a far bigger risk. And I don't necessarily look at it as much of a better reward potential than something like a Nike. So if you told me Nike versus Lulu, I'm picking Nike any day of the week. That company's gone through the ups and the downs in the whole game. Lulu hasn't. They just haven't. And when they're faced with a recession, how are they going to react to that, right? When, we'll see. Well, that's all I'll say. We'll see, how they kind of manage that whole situation, okay? All right, next video up here. The Magnificent Seven. What's going on with these stocks? What's the opinion? And I'll kind of share my opinion on these stocks as well.
And 5 stocks are down more than 10% from their annual highs, led by Tesla. That one is down.
Okay, if you told me, okay, let's play a game, okay? Let's play a dang game. Alrighty, so let's say I had to order these in terms of which one I would buy first versus last. All right, so the easiest buy right now. You forced me to buy these stocks right now. Where am I moving? Okay, so first one I'm buying Meta. Second one I'm buying Amazing's on. Third one I'm buying actually Google McDougal, surprisingly enough. Fourth one I'm buying Tesla My Esla. Fifth one I'm buying Mr. Softy. Sixth one, this is tough between Nvidia and Apple. I don't like really either one here in the short term. But if I had to pick, I'd pick actually Nvidia because there's a good probability they're just going to put up some sickening quarters over the next several quarters. So then I'd pick Nvidia. I'd actually pick Apple last. Valuation too stretched on that one. And I think, the bad thing for Apple is their revenues are going down. We aren't even in a recession. What happens? This is with unemployment at 3%. What happens to Apple at an unemployment rate of 7%, 8%, 9%, 10%? What would happen to Apple's business? If their revenues are going down while you have unemployment in 3s, I just don't know what happens to Apple in an unemployment with 7s. That's my concern with an Apple, okay? So some food for thought, maybe an apple for thought.
30%, and with bond yields reaching multi-year highs, and with the higher for longer narrative at play in the interest rate world, how should investors position their portfolios from here? Joining us to discuss is our own Mike Santoli and Mike Bailey, Director of Research and Investment Committee Chair at FBB Capital Partners. Ms. Bailey, let me ask you first, what do you think? Is this an enduring slide in these stocks? Only 2 of them are not down more than 10%, Amazon and Alphabet, but they're close.
That's right. It's a tough spot here. So, we've had this massive run here the first few months of the year. We did see 3 of these names really outperform significantly, and in particular, sentiment really blew up. I would kind of take the group down to a smaller group of, call it 3 amigos. So you've got Tesla, NVIDIA, and Meta, just massive increases in sentiment. It almost sounds kind of.
I was just talking about the 3 amigos a few days ago, but not this 3 amigos. I was talking about a different 3 amigos. These people are stealing my stuff, man. I don't like this.
But the bigger they are, the harder they fall. So we've really seen a lot of compression back in terms of sentiment falling for those 3. We've seen sort of a follow-on effect for some of the others, but I really think it's that sentiment driver. It can, run up really high quickly, and then you can also see a reversal. Looking in terms of what investors should do, I think these are generally good companies. I think you can pick your spots. The one name that jumps out for us, it happens to be, more of a modest correction territory, is Amazon. Compelling growth. Interestingly, you can buy Amazon for the same multiple as Costco. So for us, that's pretty compelling. 2 retailers out there. I think Amazon's got the lead in terms of long-term growth. So I think there's some of these names you can still own.
Mike Santoli, can the market go higher if these guys don't?
The math becomes pretty tough if they don't participate at all, or especially if they just keep going down. But a few observations. One of them is, you talked about the declines, peak to trough, from these stocks. The overall S&P is down 5%. Mm-hmm. So clearly it's not going down dollar for dollar.
And yet we're talking about correction here. Well, some people are, and this is not by any stretch a correction. I mean, it may be for those stocks that have gone down 10%.
That's right. I mean, it's not yet, broadly speaking, in any appreciable way. Now, I'll say the NASDAQ 100, which essentially is dominated by these 7 stocks, was a 36 percentage point advantage year to date.
So something very important they just mentioned there that I need to add on to, okay? They're talking about, okay, these stocks are Magnificent 7. These stocks are down so much, 10, 12, 14, 30%, right? And S&P 500 down 5%. So what does that tell you? Think for a moment. What that should tell you is that people are selling those stocks and moving that money into other S&P 500 stocks. So it's not like they're selling everything and saying, I'm leaving the market. They're selling some shares in those stocks and moving that money, rotating that money into other stocks, maybe underperformers, maybe stocks in different industries, right? And so it's important to just understand the moment in the short-term stock market cycle we're in right now. We're in a rotation period. We're not in a sell everything period. Even though if you just look at those 7 stocks, you think it's a sell everything period because you're like, man, look at all these stocks falling so much. It's not. Otherwise, the S&P 500 would have got hit much harder, right? And remember, these are the biggest weights. So it clearly just means money's rotating into other stocks out there. And, this goes with kind of the commentary we've heard over the past several weeks from a lot of these folks that go on CNBC and whatnot, a lot of these Wall Streeters. A lot of them have been talking about, hey, yeah, we're taking profits out of Meta, we're taking profits out of Apple, all these different stocks, right? And we're rotating that money into this stock or that stock. So the commentary goes also with the movement, I guess you can say, in the indexes in general.
A month ago over the equal weighted S&P 500. Now it's 28% percentage points. In other words, it's given back 6 percentage points of outperformance that had built up into mid-July to now. So has that changed the overall leadership complexion of the market, or is it just really that's where more of the air was underneath these stocks? We hit August. The overall market was a little bit stretched. We are definitely dealing with at least what the implications are of higher bond yields, but also of faster economic growth. These aren't the ones to own if you think the economy is reaccelerating. So I think all that's in the mix, but it is very difficult for the S&P 500 to perform without them stabilizing or rebounding.
Dan Niles, the tech investor, tweeted an hour ago, bond market stabilizing. Covering half our shorts today, expecting a short-term bounce next week, doubling Meta position buying Apple and so forth. So, Mike Bailey, how important are stabilizing rates to the next leg of this move here?
I think it's pretty relevant. I mean, if you look at really the overall market correction and the Magnificent Seven kind of takedown, that's coincided with a rise in rates. So I think rates are definitely critical to the conversation. If you get something unexpected out of Jackson Hole next week, if rates continue, moving north, that could be a challenge for the broader market in general and some of these big tech companies, which are pretty rate sensitive at this point. Our guess is we're not going to see that significant move up in rates from here. We saw a little bit of give back even from yesterday, but Fed's kind of a black box. We're going to have to wait and see what comes out of Jackson Hole next week.
What would you add to that, Mike?
I would, well, Kelly, you are one of my several great adversaries in the debate about how rate-sensitive growth stocks are. I'll just point out that they kind of detached coming into this year. If you looked at the Treasury market versus NASDAQ 100, obviously it matters, but it's not, to me, the one thing that matters, especially when you're talking about the super profitable large companies like the Apples and the Microsofts.
I would say from observation, it feels to me like it matters minute by minute more than it matters month by month.
That's exactly right.
If that makes any sense.
No, you're right. We're locked into a point where the main swing factor in whether I'm going to take more or less risk in stocks and in big growth stocks is, are yields going to become unhinged to the upside or not?
Right.
And so that's why you do get that tactical relationship. But if you go over a longer period of time, I mean, I looked at the last few times the NASDAQ 100 traded at like 25 times earnings, which is where we are. And the 10-year yield was anywhere from the current level to 1.5% to 5%. And then if you want to go back to the late 90s, then, all the math doesn't work, basically.
No, it's true.
All right, Mike Santoli, Mike Bailey, thank you very much.
Why was everybody naming their kids Mike back in the day, man? That's crazy. Shout out to the Mikes out there. I appreciate y'all, okay? Thanks so much for joining me, folks. Nothing else to add there. That's kind of my opinions and 2 cents on all those videos. Just reacted to a little bit of a beast video here today. Got a little break from the rain here for just a moment here in Summerlin, Nevada, but I'm sure we'll be back very soon from Hurricane Hillary. I appreciate y'all. Much love as always. Make sure you check out pinned comment down there if you want to apply to join my private group. That ability is down there. Fill out an application that will be pinned comment. Much love and have a great day.